Have you ever been presented a whole life insurance policy, but then you look at the numbers, maybe you even bought the policy and just scratch your head thinking, why did I do this again? I'm in the hole, meaning I've got less money than what I've paid into it the first year, even for the first 7 or 10 years. Like, it doesn't make sense. This happens quite a bit. So what we are going to go through today is, if you're interested in a high cash value life insurance policy, really what not to do, and then exactly what to do. So, buyer beware. Number one red flag, upfront cash value. When you're paying money into a policy, whether it's $10,000 per year, $100,000 per year, $1 million per year, whatever it might be, what does that cash value look like in the first year? If it's zero, that is a clear indicator that the policy is not designed for high cash value. If it is 50% of your payment, maybe 60 or even 70% of your payment, so I pay in $10,000 and I have $7,000 in cash value in the first year, that is an indicator that it is still not designed for maximum cash value. What is an indicator of a policy being designed for maximum cash value is typically 85 to 95% of your payment in cash value in the first year. Now, we've got 100% BOLI and COLI up on the board, and what that means is if you own a bank or run a bank or large corporations or a large corporation, banks and corporations have access to pure BOLI and COLI products, which give over 100% of their payment in cash value in the first year. That's a little bit different though. They just park money there, never touch it. They can't. It's typically a MEC, but it just grows. It's a nice asset on the balance sheet, and the death benefit has a long-term benefit for them. Another point on this, break-even point. When do I have more money in cash value than what I've paid in? If I see it taking 7 years, 10 years, really 7 years or longer, that's typically a good indicator that things aren't designed properly. Now, if I have health issues or if it's a small amount and I'm older, that could be a reason why. There are variables that play into it. But typically, if I'm paying in a decent amount, if it's $50,000 or more, and I see it taking 7, 10 years just to get my money back, that means it is designed with a high insurance premium, low allocation going toward cash value, and that's why that happens. I should typically see between 3 to 5 years to break even or get my money back, or positive return. Step number 2, buyer beware. Small companies, if you are looking for a high cash value life insurance policy, do you want to do what might work and has not been proven out before, or do you want to do what the elite and wealthy do? Regardless of your dollar amount. I'll share a story here. So working with someone, he took out a policy. He puts in about $400,000 per year, a little north of $500,000 per year into a cash value life insurance policy. He was pitched on smaller companies. Now, he's in the business. He knows companies. He knows what to look for. He's looking at a small company and he simply said, there is no way I am going to flow this amount of money with this company that I don't have confidence in. I have not heard of them, or I've heard of them, but I haven't seen any proof. And what I mean when I say no proof is not financial ratings, company size, none of that stuff. I'm talking about actual policy performance. Simply, can we get a policy from a company, not an illustration, because I can model out some companies that look really good, a real policy that says, hey, here's the actual performance. It's proven. They've always delivered the strongest cash values. And here's what I've seen to be consistent. And this is when I was a designer at a corporate planning firm, and in my years of running a business for myself, my personal policies, 4 major mutual companies have delivered: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. And I can't even sell or offer Northwestern Mutual. The simple reason I mention them is we've seen them consistently deliver. That's why. Now, that's not to say small companies are bad. This is not meant to be just a negative video towards small companies. Some of them, there's one particular that's working with us constantly to try and obtain proof of performance. And I appreciate that. They've got a great business mindset, and we're seeing them do a lot of good as well. And we've done a video on them in the past, so you might know who I'm talking about. But we've seen the wealthy do this. We've seen these guys consistently deliver. This point, dividends and loan rates. Have you ever heard, hey, you can put money in a policy that's earning a dividend of 5, 5.5, maybe 6%, and borrow from it at 5%. So you've got a positive 1% spread. Sound good? That can be a little bit, I don't want to use the word deceitful, but tricky. Here's the thing. When you have a dividend rate on a life insurance policy, that is not what you are actually earning. And my company sells whole life insurance. That is the main product we sell. So I'm not attacking the product. We're attempting to make it transparent here. When I see a dividend rate on a policy, that is a gross rate that is credited after the company's insurance expenses. Meaning if I see a 6% dividend rate, I might see a net internal rate of return. That's what that IRR means. Actual growth rate of 4%, maybe 4.5%. So that's what I like to look at. So when I'm considering borrowing from a policy, if I get into a product thinking I'm going to earn 6% and borrow from it at 5%, and policy loans are so simple, I can request them, get my cash value, easy all day long, that sounds great. But if you bought that and then find out after the fact, wait a minute, I'm earning 4% and borrowing at 5%, that costs me now. I would have done something differently if I would have had the awareness beforehand. So I want to build that awareness beforehand. What are some alternatives I can use instead of policy loans with still leveraging a cash value life insurance policy? So always look at the actual growth rate. And this is assuming high cash value is your point of interest. MEC, so this topic we hear a lot. If you have been interested in a high cash value life insurance policy and you're looking at different designs and you ask your agent, hey, can I get that cash value higher up front? Like, I'm liking this long term, but man, that's a hit up front. Can we do anything to improve it? And then you hear, well, we can't because it'll MEC. A MEC is a modified endowment contract. It results in taxes. We hear that. It's confusing. We think, okay, I guess you've maxed it out. I'm good with it. The thing is, a policy can easily be designed where it's not a MEC. The ultra wealthy elite have been doing it forever. I'll share a quick story. We've got a podcast with the best attorney I've met, period, Elizabeth Morgan and her firm. When I first met her, she was interviewing me. I shouldn't say interviewing. I feel like I was being put under the fire. She was testing me, really. She knows cash value life insurance in and out. She actually helped a company design a product, AIG, I believe it was. But meeting with her and her clients at the same time, going over the numbers after we talked a bit, and she's looking at the policy and she mentions, hey, that policy there, it's actually good how you have it designed with the whole life and term because it prevents a push out. What she's talking about there is a long-term modified endowment contract occurring, which happens with life insurance policies. I was blown away because we've studied that. I've looked at that so many times. I'm like, how do you know that? Like, a lot of people in the business don't even know about that whole push out and how MECs can occur long-term. They just take what they see off the software. My point here is here you've got an attorney that works with people that have just tons of money and put tons of money into cash value life insurance products, and she knows what to look for. She's consulted them for a long time. So my point is if you hear, well, you can't get 85 or 90% of your payment up front because it will MEC, I would question that further because it is possible. That's what the wealthy do. That's what corporations do. And you don't have to be a corporation or wealthy to do that. Really, it results in this, the compensation being reduced by the agent. Here's one truth. When you design a policy for maximum cash value, it results in a minimum commission up front. And when you look at it on a residual basis, it's less as well. However, and this may speak to you if you're an agent, because this has been my mindset from day one, since I branched off on my own, is if you design a policy for maximum cash value, minimum commission, that business, is it going to lapse? Or are they going to go shop competition and have people look at it? Maybe they will, but it's going to stay on the books because it is maxed out for consumer value. So you don't have to worry about competition coming in and scooping up your clients. You don't have to worry about policies lapsing, someone canceling it because they're not satisfied or they're tired of waiting 10 years to get their money back. My point here is yes, it's a minimum commission up front, and yes, it's a smaller renewal, but it just keeps on compounding as you attain more clients over time. So really it's a volume-based approach, but in my opinion, you can sleep at night because you're designing policies for the consumer's benefit, assuming this is what the consumer wants, high cash value. I'm not saying all agents are bad that sell products that have higher premiums here with higher commissions. That's not the case. But if someone wants a product for maximum cash value and I sell them something else, that ain't right, especially if I'm doing it for a commission here. So on the topic of commission, here's one thing I've seen, or commissions. Someone gets very emotional on commissions, starts lecturing or yelling at their client. That's a clear indicator that they're hiding something. Like, why would I start fighting or painting this big picture, this long story about compensation? Like, how's it work? Transparency. It is what it is. Money that goes toward the insurance premium, the bulk of compensation is paid on that premium in the first year. The 4 major mutual companies on traditional products in the first year will typically pay at the highest level between 85 and 95% on that premium in the first year, which, by the way, with this, you are minimizing that premium as much as you can because you're beefing up the cash value. Now, smaller companies won't pay between 85 and 95% commission the first year in premium. They pay often, highest I've heard of is 140, but the highest I've seen is 135% on commission. But we don't see the performance there. And then people try and jack up the base premium. It's like, what are you doing, man? If somebody wants a high cash value product, don't try and sell them with these great words to try and get them to get into the product so you make more money. Again, not everyone's like that. Just we see it and I get emotional sometimes. So anyway, hope that this helped. If you enjoyed this video, please click the like button, subscribe for more, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.